when that deal with New Media and Gannett came out, you had this $1.8 billion loan attached to it. This is a type of loan that would normally go through the big banks in the old days. Apollo was basically the lead on this. What is the trend here? Why are we seeing more of these private equity firms making these types of loans instead of the traditional banks?
So the private equity firms have a credit arm that is massive. And direct lending, which is a hot strategy because people are reaching for yield and has received about $80 billion in the last 3 years in just North America alone. They're getting amassing huge pools of capital, and they want to deploy it in bigger and bigger deals.
Okay, so they have a lot of money to use and to put to use. How early on in this shift are we? I mean, is this just the beginning, or have we seen a lot of it play out?
Oh, it's very much in the beginning. So even before this year, you saw maybe 1-2 deals in which a direct lender would take $1 billion on its own. And now it's a fairly regular occurrence. But yet still, the projection is for far more. Apollo estimated that in the next 5 years, about as much as 10% of the high yield bond and leveraged loan market could go private.
Wow.
For borrowers, I mean, what's the incentive to sort of align yourself with some of these private equity firms as opposed to the traditional banks?
So then you have 1 or 2 lenders instead of the masses of institutional investors that the banks will sell to. And so that can mean faster execution, more certainty. But sometimes you can even get more leverage than in the broadly syndicated market.
Okay, let's take a step back here for a little bit, because a lot of times when we talk about the big banks losing out on some business, people will say, oh, it's because of the regulatory environment. The regulators are basically restraining the big banks from being able to do what they were always able to do. How much does regulation play into this shift?
So there is some element of that. You're right on point, because there is a leveraged lending guidance. But that's been very much defamed by the Trump administration. But banks don't want to totally go afoul of their regulators and do loans and deals that would have incredibly high leverage. So some of that could seep into the direct lending space. But also at the moment, the leveraged loan market is more volatile than, say, the high yield bond market. And this is giving it opening for direct lenders.
Are we still seeing the same level of transparency if you're an investor to be able to see not only what these loans are, but exactly the types of restriction and covenants that might be in place?
So if you're an investor, you might have more transparency because you're maybe the 1 or 2, and so you have a closer relationship. But regulators and people who watch financial stability, they won't have as much knowledge. And so that is, people are worried about the growth of this marketplace, particularly for that reason, and also the growing risk of illiquidity.
Yeah, only those directly involved get that access.
Yes.